We are witnessing an unprecedented escalation in economic and trade tensions between the United States and Canada. U.S. tariff policies under President Donald Trump continue to disrupt the North American supply chain, creating ripple effects from the auto industry to consumers, manufacturing plants, financial markets, and global confidence. Starting on March 12, 2025, the administration of President Donald Trump officially imposed a 25% tariff on steel and aluminum imports from Canada, citing Section 232 on the grounds of national security. But it didn't stop there. Less than 3 months later, on June 4, 2025, the tariff rate was doubled to 50%, sparking major concerns across the North American business community. In parallel, beginning on April 3, 2025, the U.S. also began imposing a 25% tariff on imported cars and auto parts, targeting not only Canada, but also China and Mexico. In a high-profile statement, President Trump declared that these tariffs were meant to protect American manufacturing, emphasizing, at 50%, the competition won't be able to jump the fence anymore. On March 13, 2025, Canada responded with a strong retaliatory move by imposing a 25% tariff on approximately USD 29.8 billion worth of imported U.S. goods. Notably, this included USD 12.6 billion in steel, USD 3 billion in aluminum, along with a wide range of household products, machinery, and industrial equipment. Then, on April 9, 2025, Ottawa escalated pressure further by introducing a 25% tariff on U.S.-made vehicles that did not comply with the USMCA agreement. This tariff took effect on May 3, 2025 for complete vehicles and on June 4, 2025 for auto parts, with certain exceptions for intra-block products. This twin tariff strike had immediate, tangible effects. Stellantis was forced to shut down its Windsor plant for 2 weeks, directly impacting around 3,600 workers. In response to the U.S. retaliation wave, the Canadian government swiftly established a CAD $2 billion strategic response fund, approximately USD 1.4 billion, to support the domestic auto industry and protect workers. This fund, announced by Prime Minister Mark Carney in late March 2025, is aimed at job retention, upskilling the manufacturing workforce, and developing a pan-Canadian auto supply chain to reduce dependence on U.S. and other foreign suppliers. Specifically, the fund will assist auto businesses in remaining compliant with CUSMA, USMCA, while maintaining production. It will also allow them to import a limited quota of U.S.-made vehicles tariff-free, provided they continue to invest or produce in Canada. Additionally, the government rolled out temporary 6-month support measures for U.S. imported goods, essential for domestic production or critical sectors, such as healthcare, public safety, and food sanitation. Prime Minister Carney stated, "We will protect workers from U.S. tariffs, create better-paying jobs, and build a fully Canadian auto manufacturing network." This initiative marks a clear strategic shift to fortify the domestic auto industry, Canada's second-largest export sector, while mitigating the impact of unilateral U.S. trade policies. Amid escalating trade tensions, General Motors, GM, reported its Q2 2025 earnings with a staggering 35% drop in profits. Of this, losses due to import-export tariffs alone were estimated at around USD 1.1 billion. Analysts warn that if this situation persists, the total impact on GM and related companies could reach USD 4.5 billion. Facing rising cost pressures, many manufacturers are being forced to consider response measures, such as relocating production domestically, cutting operational costs, or postponing expansion plans to remain competitive. In early July 2025, Honda announced it would relocate production of its CR-V SUV from Ontario, Canada, to the United States to reduce tariff costs and protect profitability amid the 25% import duty on both auto parts and complete vehicles. According to a recent statement from the GM CEO, the company has allocated a portion of its potential profits to increase domestic investment by USD 4 billion, including USD 900 million specifically for V8 engine production and boosting SUV and pickup manufacturing in the U.S. GM is also absorbing tariff costs instead of fully passing them on to consumers. At the same time, it aims to increase domestic production by 300,000 vehicles by 2027 to avoid heavy import tariffs from Canada or Mexico. According to 2024 market data, approximately 45% of all light vehicles sold in the United States contain components subject to tariffs, and notably, nearly 23% of those components are imported from outside North America. This has disrupted the entire assembly system, which traditionally relies on a just-in-time operations model. A recent report from TD Economics warns that if current tariff levels remain in place through the end of 2025, U.S. vehicle sales could drop by around 4%, while in Canada, the decline could be even more severe, up to 7.5%. These figures underscore the risk of long-term damage to the North American auto industry if trade tensions are not resolved soon. Smaller suppliers are struggling to cope with tariff-related costs, facing canceled orders and temporary production halts, leading to a heightened risk of job losses and bankruptcy. F&P Manufacturing, an auto parts producer based in Windsor, Ontario, is a key link in the supply chains of major automakers like General Motors and Stellantis. Since the United States imposed a 25% tariff on vehicles and parts from Canada, in early April 2025, F&P and other Tier 3 suppliers have been hit with sudden order delays and cancellations. Prices are rising sharply, creating a double impact on both U.S. consumers and businesses. According to an analysis by J.P. Morgan, the price of new vehicles could increase by USD 4,000 to 5,300 due to soaring tariff and raw material costs, especially amid record-high aluminum and copper prices since the beginning of the year. Meanwhile, a report from the Yale Budget Lab revealed that the cumulative impact of current tariff policies is costing the average U.S. household approximately USD 2,400 in lost real income by the end of 2025. On the macroeconomic front, the U.S. annual inflation rate reached 2.7% as of June 2025. Although the increase may not seem drastic, its underlying components paint a worrying picture. Many import-reliant businesses, particularly in consumer goods, machinery, and automobiles, are absorbing much of the tariff burden themselves instead of fully passing it on to consumers. However, this is only a temporary fix. The mounting cost pressure is gradually forcing companies to adjust price lists, leading to a steady rise in the cost of basic goods and services. August 1st, 2025, has been identified as a critical deadline in the ongoing trade tensions between the United States and Canada, as the Trump administration has threatened to raise tariffs to 35% on imported Canadian goods if a clear trade agreement is not reached by that date. However, as of July 28, 2025, Canadian Finance Minister Mark Carney stated that bilateral talks had not made sufficient progress to fully eliminate the existing tariffs. He also emphasized that the U.S. had yet to present a clear roadmap or action plan for the next steps, forcing Ottawa to maintain a firm and defensive stance. Meanwhile, Canada has proactively prepared for further retaliatory measures, with plans to adjust counter-tariffs starting July 21, 2025, depending on the outcome of the negotiation rounds. These measures may include expanding the list of taxed goods and tightening exports of electricity and strategic materials, such as aluminum and steel to the U.S., aiming to exert reverse pressure on an already fragile American industrial supply chain. This standoff reveals that the issue is more than a simple trade war. It's a battle of policy and trust between two of the closely interlinked economies in the world.